All right, guys, I think we're ready to get started here. It's 4 o'clock Eastern time. So first, on behalf of Scott Jones, Ryan Ironman, we want to thank everyone for joining us for our second quarter market review. And thankfully, we've had a really good quarter. Started out a bit slow, but we've recovered nicely. So let's go ahead and jump in here. And as always, if there's questions, by all means, you can type them into the chat box, or you can reach out to one of us. I know on most of these calls, it's a lot of clients of ours currently, so you've got our contact info. But if you don't, here it is for the three of us. And again, I'm Brian Reese, accompanied by Ryan Ironman, who will present after me, and then Scott Jones will finish out the presentation today, talking about fixed income, giving us some updates there. Try to keep this right to about 30 minutes or so. Try to respect everyone's time. So if you do have questions, though, go ahead and type them in the chat. If we've got time, we'll get to those during the session. If not, we'll get back to you afterwards. But you can always reach out to one of us. So beyond the three of us, we always like to remind people that we've got a team behind us. And on this screen, you see in the picture on the right-hand side, Adam Ironman, Tim Ironman, who leads the team, and then Julianne in the dark blue shirt. Davey is not pictured here, but Davey is a part of the team as well. So kind of rounds out the team here, Crocker Park in Westlake, Ohio. And if you haven't been into our office, if you don't work with us yet, by all means, give us a call, shoot us an email. We'll have you come out and check out the Crocker Park location. So a quick overview of services before we jump into the quarterly review. Nothing really has changed here. We're still busy doing all the things that we do when it comes to making sure we're seeing clients, following our service plan. A lot of those are being done still in a good number in person, but also plenty of Zoom meetings and phone-based meetings. Really, we want to be there for you guys, our clients, and make that as easy as possible. If you don't feel like leaving the house, definitely can do a Zoom or a phone meeting. And then when it comes to our 401k plan clients, Scott, especially Scott, Adam Ironman, and Tim Ironman, are out doing quarterly review meetings, and then some follow-up one-on-one meetings with employees too. And whether it's in that setting or in our personal planning world, we've got a host of tools and calculators and planning software that we can use with clients. So just as a reminder, and it's always good to make sure you get your plans updated. A lot of things changing in the world that we'll talk about here in a minute. So making sure your financial plan is updated is equally as important. So the agenda for today: market update, key themes. Ryan will really touch more on the stock market. And then, as I said, Scott hit more on the bond market. A couple of reminders about diversification. And diversification is still, as it always has been, it's a reminder that diversification works, and Scott will hit on that, but diversification works, and it's still one of the foundations of any sound investment portfolio. And then Scott, once he wraps up, we'll talk about available resources as well. So with that, let's jump into the market update. My part really is the covering where have we been, and the first slide that we use is by our friends and partners at Raymond James on the investment management team. The CIO, Chief Investment Officer Larry Adam, puts a lot of this information out for us. So Raymond James has 4 things that they are currently keeping an eye on in their quarterly reporting. First one, not a surprise for anybody on the call. First one, though, is the economy when it comes to trade talk and tariffs. So we'll talk a little bit more about that, but early in the quarter, very start of the quarter, we saw trade uncertainty really rattle the markets. And then once we started to get more clarity on the tariffs, markets not only settled down, but rebounded really, really nicely. So as everyone probably sees on the daily news, we're working through the U.S. government, President Trump, are working through the negotiations now, and we're seeing updates on a daily basis. Still waiting for probably the biggest one, which is China, to see what that is finally going to look like. But nonetheless, trade and tariff uncertainty rattled the markets early, but definitely a nice recovery. Three other points though that Raymond James keep an eye on. One, politics. Has U.S. lost its safe haven appeal? Uh, what they're looking at here is the treasury market, mainly the treasury market, strong dollar, weak dollar, and overall the term that they like to use is U.S. exceptionalism. Is it dead? Is it not dead? But nonetheless, just seeing measuring where the U.S. is as compared to the rest of the world, and especially our European partners. And I don't think there's any doubt that the U.S. dollar is going to remain the world currency, but there is some talk around that as well. So again, just topic that we're keeping an eye on. Commodities. This has been a bullet point in an area of focus for some time when it comes to data center build outs. So we've got a slide later on about AI and where that's been going. But the data center part of it is they've built and will continue to build a lot more around the data centers, which means there's going to continue to be more pressure on power on the grid and the power to power those up. And then water. Water is another one, not as talked about, but definitely something that we all need to be aware of as they power these data centers. And then the last one, it's a Q&A. Rumors of the dollar's demise are exaggerated. I kind of hit on that, but you see over in the middle under the economic snapshot, what we're neutral on is exactly that. Right in the middle is neutral on the dollar, the rest of the world, monetary policy. So yeah, so really that's really what we're focused on at Raymond James from a big picture, how our portfolio is designed. These are definitely some of the key factors within there. Where have we been over the last quarter? We always do these a couple weeks after the quarter end, but the second quarter delivered exceptional equity returns, driven largely by the same companies, a little bit more broad now, but definitely driven by technology and communications, AI. We saw growth in the NASDAQ, jumping down three lines, but growth in the NASDAQ in the second quarter at close to 18%. S&P one line up. S&P had solid returns in the quarter of 11%. Just as a reminder, the S&P 500 long term over the last, call it 75 or 80 years, has averaged about 10% return per year. Now we saw the downturn early in the quarter, but to be up 10% on the S&P just in the second quarter is pretty phenomenal. A little bit more muted return on the Dow Jones Industrial Average, so about a 5% return there. If we go down a little bit further, let's see, 2-year Treasury at 3.71, 10-year at 4.23. These are remember as of the end of the second quarter. 30-year mortgage, that really hasn't changed. I know we look back a year ago and it was a bit higher, but I feel like it's been hovering in that 6.75, 6.8 range for some time. Gold closed the second quarter at 3,300, which second quarter return on gold was 5%. Oil down about 9% on the quarter, and the 12-month return on on oil down about 20%. Up 40% on gold. So I know Scott will hit on it, but remember, all this is about diversifying, making sure that you're properly diversified based on the risk that you should be taking and the time that you have until you need to start using some of the money. And then the Magnificent Seven performance. I think that once, and I'll go through some of the numbers on here, but I think that once if it continues where we're broadening out where we're getting returns from, we may start losing this Mag 7 terminology. We'll see how it goes, but forming some different names to different groups of stocks. But the Mag 7 performance has been phenomenal when we look back over the last few years. On the left-hand side, we see that if we start in 2021, we see 2021 S&P returned 27%. Without the Magnificent Seven, the return was 17%. So S&P 27 without them, that is up 17%. Magnificent Seven return alone, 40%. It 2022, remember that was a down year. 2022, as a reminder, was one of the worst years we've seen in the stock market's history. And not to steal any thunder from Scott, but it was the worst year in the bond market's entire history. But nonetheless, S&P down 19 in 2022, and then S&P without the Mag 7 down 8%. Mag 7 down 40% in 2022. 2023 was a huge year. S&P up 24%. Without those 7 companies, the S&P was only up 8%. Remember, that's pretty darn close to the long-term average, though. Mag 7 returned 76% that year. Year to date, as I said, we're starting to broaden the returns out where we get the returns from. So year to date, the S&P through the second quarter, S&P at 5%, or wait a sec. Yes, 5%. S&P without the Mag 7, 5%, and then Mag 7 only with a 3% return. So the good news about all of that is if you are diversified properly, the Mag 7 did really well for us. And then being diversified means that the rest of the stocks, as profits have and earnings have come out, have been looking pretty darn good. Being diversified has helped in that regard, and having a balanced approach to it all has worked really well, like it should. It's a big week for earnings, so we've got some of the Mag 7 announcing this week, and companies outside of the Magnificent Seven got a good number reporting this week, so it'll be a big week. And then the Fed is meeting this week, so we're going to get a decision on whether they're going to cut interest rates or not. So we've got a lot of things going on both in the stock market and in the bond market, and there's a lot of pressure on the Fed to lower rates. Now, of course, they shouldn't succumb to pressure if they're not supposed to be lowering rates, but we're going to see where that goes a little bit later this week. So I would say overall, though, where we've been in the second quarter, that trade uncertainty, we had a lot of clients nervous early on in the quarter, and then most everyone understands hanging on and staying invested, and investors were rewarded for doing that later on. So we feel very optimistic still when it comes to the market, and now that we're through with some of the trade uncertainty and the tariff uncertainty, we feel really good overall. And then, as we all know, earnings drive the market. That's the number one thing. Earnings. So we're gonna start to see how everybody reports here very shortly. So with that, I am going to turn it over to Ryan to talk a little bit more about AI. Let's see, Ryan. Let me get you control of the screen first, though.
All right. Thanks, Brian.
Yeah.
I'll get started here. So yeah, this slide is really looking at the capital expenditures of what they call the AI hyperscalers. And the hyperscalers are just the big tech companies that are investing money into these big data centers and cloud computing. That's going to be driving a lot of the AI implementation moving forward. So mainly Google, Amazon, Facebook, and Microsoft. And so the chart on the left here is looking at their total capital spending. And as you can see, in 2025 or in 2024, that was up close to 200 billion being invested into AI build out. And then as a percentage of their operating cash flows, which is the blue line there, you can see it's starting to creep up to right about 50% of their operating cash flows. So pretty significant expenditures going towards these companies investing in their AI infrastructure. And that trend looks like it's just going to continue to keep going up as far as we can tell. And then over on the right is the leaders in terms of different sectors and who is starting to implement AI to help produce their goods and services so far. So as of June 2025, the information services is leading the way, followed by professional and technical, and then educational services behind that. So moving on, again, we always like to revisit this chart here. This is the S&P 500 returns going back to 1980. The gray bars on the top, where the market finished for the year. The red dots along the bottom are the low point for the year. So as you can see, year to date over on the right, at the end of Q2, we were up 5%. And then the red dot at negative 19%, that was back in April during when the tariff announcement came out, and the market had a pretty big correction. But the main point of this chart is that long-term investing continues to be our main focus, and 75% of the time the market finishes up. So that long-term investing does tend to pay off if you stick with it. PE ratios is the next chart here. So price to earnings ratios, you can just think of it as sort of the relative valuation of the market. High price to earnings would indicate that the market is overpriced. Low price to earnings ratio, market is underpriced. So the 30-year average going back to 94 is at 17x, and we're currently sitting at 22x. So it's kind of indicating that the market overall is a little bit overpriced right now. We're not saying that the growth won't continue from here. It's just one data point that we look at, and something to consider as we move forward. And then this slide goes into a little bit of our investment framework. When we look at putting together investment strategies, and when we're looking at the economy, this sort of rank orders the factors that we consider as being important to our decision, and then all the way down to the least important. So over on the left, economic growth is the number one thing we're paying attention to. What part of the business cycle are we in? Are we in a bull market? Are we in a recession? What's the employment and labor market looking like? And then consumer spending is really one of the main drivers of the economy. So those are the main things we're looking at, followed closely by things like Federal Reserve policy. What are the interest rates doing? What's the dollar doing? and then company fundamentals. How are earnings looking? What's corporate management? What direction are they going in? And then the strength of their balance sheets. And then all the way down, sort of at the bottom, just to keep this brief, is things like natural disasters and politics and geopolitical events like wars and tensions between various countries. But overall, this is just a good a way to kind of keep things in perspective on what's important when you're thinking about your investment portfolio. And then with that, I will pass it off to Scott, and he's going to talk a little bit about the bond market.
Great, thanks, Ryan. Thanks for everybody for joining us. So I'm just going to hit on some key highlights in impacting fixed income. We've seen some better returns this year. It's been a while since we've been able to see positive results from some of the fixed income markets. Brian talked about 2022 being a fairly negative year, one of the worst years that the bond markets had. That was largely due to the rise and increase in interest rates. So this chart's a little busy, but I'll just kind of go through some of the highlights. I think it's kind of important to consider when you're making any portfolio decisions. But I'll look at this U.S. aggregate return through the second quarter of 2025 is up 4%. That's what we would refer to as a typical bond fund. That's a lot of times in 401k plans that we manage. So, up 4%. The S&P was up 5% through the second quarter. So, obviously a lot less volatility with bonds, fixed income. So pretty nice return there. And then these other ones just go through different returns of the U.S. Treasuries and different maturities, high yield, municipal bonds, mortgage-backed securities, and other different bond types. On the right side, I think it's kind of important to look at what would happen if there was a change in interest rates. So we haven't really seen much change. There's going to be a meeting on Wednesday. There's a lot of banter that you're hearing about, I would say is probably the best word to describe it, between the White House and the Fed. But you have to remember the Fed is considered to be independent, and there's a lot of focus on whether or not they will change course this week based on comments, because if we're just looking at employment and inflation, there's a lot of folks who would probably say there isn't a need for them to cut at this time. Whether or not they will consider pressure to do that, we'll have to wait and see. But so the light blue area here, or the light blue return, I'm going to again focus on U.S. aggregate because that's probably our most common bond type that's in a 401k or a portfolio. If there was no change to interest rates, we would expect a return of 4.5%, basically the yield on that bond. But if there was a 1% fall in interest rates and rates were to come down 1%, you could see the return would be upwards of 10.5% there. So these dark blue bars are the results if we were to see a 1% decline or decrease in rates. And the next page here will kind of show you, what's kind of what the marketplace is expecting rates to do. So it's going to move forward here one page. So this is the outlook for Fed and interest rates. You can see, we had that big increase in 2022 that led to a lot of the negative bond return performance in that year. We stayed kind of consistent, and then we've started to decline. But the colors that you see here are kind of the market expectations of where rates will be over the next couple of years. And you can see even the FOMC year-end estimates are lower. So, looking back on that previous chart, if that plays out, that could lead to potentially a decent return in fixed income with fairly low volatility as an opportunity. So, it's just something to think about. Obviously, you want to take appropriate risk given your age, where you're at in your goals and retirement planning, time horizon, things like that. But we would say based on these factors, the outlook for fixed income returns looks favorable over the next couple of years if this rate pattern plays out. Just gonna move forward here. We'll look at some other things to consider as far as asset class returns. So this is a chart we talk about, again, importance of diversification. Just goes through each asset class, and typically every color of that box that you see here is usually available in it's a standard 401k plan, and so you can see over on the far left, large cap, the green box is what large cap U.S. stocks, we would call that the S&P 500, and that's really been the best returning category investment over the last 15 years. You can see in 2023 and 2024, upwards of 25% each year. A lot of that was led by the growth in technology and the Magnificent Seven stocks that Brian kind of talked about. But year to date, we actually seen kind of a change a little bit. This developed market equity, this gray box, is actually international stocks, which has been a lagger over the last 15 years. You can see only averaging 5.7% each year, much less than US stocks over the last 15 years. But you can see international has started to do better over year to date. We don't necessarily think that's going to be the case over the long term, but things like tariff news and the dollar actually declining in value has kind of led to international stocks outperforming US stocks year to date. So we'll kind of keep an eye on where that sits. But again, the purpose of this chart is we don't want to, you want to buy low, sell high. So you don't want to try to chase returns. And a lot of times you can see examples of where, in 2021, this blue box, light blue, is real estate, was the best returning investment, but in 2022 it was the worst performing investment of the available ones here. So you don't want to chase returns because a lot of times, again, in emerging markets in 2017, light purple box, best performing investment. In 2018, it was the worst performing investment. So what you'll see here in the middle is this white box that stands for asset allocation. That's really diversification, spreading your money across all different types of investments. And so if you've been a part of our 401k plans or as an individual investor, we have portfolios that are appropriate based on your risk tolerance and things like that we use to diversify. So that's kind of just an overview of where we've gone for the last 15 years and then year to date as well. So we're getting a lot of people that are comfortable with cash. We actually have a record high percentage value of cash on the sidelines. It's over $7 trillion. Currently that sits in money market funds. And if you remember briefly that interest rate chart and the projection of where rates are predicted to go, that would mean that those money market rates would come down over the next couple of years. So I thought this chart was good to look at because people are considering putting new money to work and they're saying, I think I'll just stay with a CD or 4%. And I don't want to buy when the market's high. but this just looks at a balanced 60-40 portfolio. So 60% in stocks, 40% in bonds, and the percentage of time that portfolio would outperform cash on a rolling basis over the last basically 30 years. And it looks at just different rolling year periods. So you can see for pretty much 80% of the time, a balanced portfolio over 1 year or longer is going to outperform cash. And when you get out to this 10 or 15 years even, if that's your decision to invest that cash and you don't need it for the next 10 years, well, in that example, a balanced portfolio is going to outperform 90% of the time. Or if you go 15 years, 100% of the time, that would be a better returning investment than sitting on cash. So even if you look at 3 years, it's hard to predict anything less than a couple of years, but just you have to look at the long-term impact of investing and not just make a decision based on today, because it's likely those rates will come down. And if you're investing for any longer period of time than a year or a couple of years, you're probably more than likely going to be better off investing at least in a balanced portfolio or higher, more aggressive. So, and then we just have one more chart I'll finish up on. Kind of along those lines is missing the best days and impact of being out of the market. You may have seen something like this similar before, but it's just showing you the performance of $10,000 invested between 2005 and 2025. So for 20 years, if you had been fully invested the whole time, you would average about a 10.4% return. That $10,000 investment would have grown to $71,750. So everybody would be very happy with that. Well, what if you missed the 10 best days? You can see just in missing the 10 best days, you come down to almost half of what you would have had, 6% return, but in 32,000. And then it just compounds and gets worse as you miss more days. So very important to not, again, if you're sitting on cash or you're nervous about getting money into the market, missing those best days really can impact your overall return over time. So again, just important to stay invested, stay diversified in the appropriate strategy. We can help you with that. So, again, we talked about different options, what's inside of 401k plans. We do have what are called target date investments. We have risk-based portfolios that we build a lot of times that can help you pick which one is appropriate for you. But again, use the professionally managed options, utilize us as a resource, and you can always, build your own, but it's usually best to reach out and take a professional approach to that construction. So this is just a risk questionnaire. We have two versions of this. The version on the screen here is for those in a 401k plan that we're managing. We also have another version for individual wealth management clients that Brian or Ryan could walk you through, and just making sure that you're in the appropriate portfolio. Our contact information is listed here. Please reach out to us. We're also coming out with a way that we can schedule online scheduling. So we'll be kind of announcing that shortly. It'll be a way that you can basically set up a Zoom meeting, an in-person meeting at our office, or a phone call for 15, 30 minutes or an hour for any one of us. And just it'll allow you to pick kind of the calendar date that works best for you based on our availability. And so keep an eye out for more information on that. But we're trying to continuously offer ways to contact and connect with clients and be available. So with that, we have just a couple of disclosures here, and then we're going to go ahead and wrap up the call. There will be a recording. If you follow us on LinkedIn, or if you go to the YouTube page, we post out the replays of these calls in the past the past calls are all out there based on history. So if you missed something, you want to refer back to something, we will post the replay of this call out to our YouTube page, probably within the next couple of days. So with that, appreciate everybody's time. Thanks for being with us, and we'll talk to you next quarter. Take care, everybody.